Welcome to the deep dive. Today, we're taking a close look at Webster Financial Corporation. We'll be pulling insights from their recent Q2 2025 earnings call and, their detailed press release.
Right. And our mission, like always, is to sift through all that data, pull out the really important nuggets of knowledge, basically give you a shortcut to understanding what's driving Webster and what it means for the bigger financial picture.
Exactly. We're going beyond just the headline numbers.
Yeah, we'll dig into their strategy, what makes them different, and think about what their forward-looking statements really imply.
So, yeah, get ready for maybe some aha moments that should leave you well informed about this key regional bank. Let's kick things off with their Q2 2025 financials, because the overall picture here looks quite strong.
It does. Despite, some of that macroeconomic uncertainty earlier in the year, Webster's actually right on track. They're meeting the outlook they set back in January.
And what specifically stands out from the metrics?
Well, several things. Their return on tangible common equity, ROTCE, it's at a robust 18%. That's pretty strong.
Yeah.
And return on average assets, nearly 1.3%. Plus, they grew both loans and deposits over 1% compared to last quarter. So, healthy, balanced growth.
Okay. And overall revenue.
Up 1.6% over Q1, so good momentum there.
And that net income number, it really jumped, didn't it?
It certainly did. Net income for common stockholders hit $251.7 million. That's $1.52 per share for Q2.
Wow. Compared to last year.
Yeah, big jump from Q2 2024. That was $175.5 million, or 1.03 per share.
So it's not just growth. It suggests they're getting much better at turning revenue into actual profit.
Exactly. Better efficiency. That's critical in today's banking world.
And this ties into their capital strength too, right?
Absolutely. Their common equity Tier 1 ratio, CET1, that increased to 11.33%.
Which means?
It signals really good resilience, flexibility, and they back that up by authorizing another $700 million in share repurchases.
Did they actually buy back shares?
They did. 1.5 million shares in the quarter at an average price around $51.69. Shows they're confident in returning value to shareholders.
Okay, good overview. Now, one area I was really watching was asset quality. They talked about an inflection point coming mid-year. Is that actually happening?
It looks like it, yeah. The signs are positive, both criticized commercial loans and non-accruals. Those are the problem loans. Essentially, they were down this quarter.
That's a good sign.
Definitely. And their net charge-off ratio, the loans they actually had to write off, was 27 basis points. That's 0.27%.
Is that high? Low?
It's right in their expected long-term range, which is about 25 to 35 basis points. It's under control. And crucially, they said they're not seeing any new pockets of credit problems popping up anywhere.
What about tariffs? Any concerns there?
They addressed that. Said they don't have any disproportionate exposure, and their borrowers seem to be managing costs and supply chains okay. So that proactive risk management looks like it's working.
Okay, that's reassuring. Now, let's shift to what really makes Webster stand out. Their strategy, starting with Healthcare Financial Services, HSA Bank, and Ametros.
Right. This is key. They call it a differentiated deposit profile. Basically, a growing source of deposits that are low cost, long duration, and very sticky.
Sticky? Why are they sticky, and why does that matter?
Well, sticky means people don't move the money around much. HSA Bank uses this B2B to C model, business to business to consumer.
Okay.
They partner with employers, health plans, who then offer the health savings accounts to employees or members. People tend to keep their healthcare savings in one place for a long time.
Ah, so it's stable funding for the bank.
Exactly. Very stable, low-cost funding. And there's some big news here. New legislation just passed. 3 provisions favoring HSAs.
Oh, really? What do they do?
Well, the main thing is they significantly increase the potential market, mostly by making people with bronze ACA plans eligible for HSAs.
That sounds like a big deal. What's the potential impact?
They're estimating it could mean an extra $1 billion to $2.5 billion in deposits for HSA Bank over the next 5 years.
Wow.
Yeah. And maybe $50 to $100 million in growth next year alone. Plus, HSA eligibility isn't tied only to high deductible plans anymore.
Even bigger pool, then.
Potentially, yeah. And there's more talk in Congress about other provisions that could even double that opportunity if they pass next year.
And the cost to Webster.
They say no major change to expenses for HSA Bank. They can leverage their existing setup. Pretty efficient.
Interesting. Okay, beyond HSAs, they also rebranded Interlink to Intersync. More than just a name change.
Seems so. It's framed as deepening their access to what they call granular deposits. Think smaller, stable accounts from individuals and businesses.
So diversifying their funding even more makes their liquidity stronger.
Precisely. A differentiator, especially for a regional bank right now.
And another big strategic move, this asset management partnership with Marathon. Tell us about that.
Yeah, this is significant. It's not just a small collaboration. It's about boosting their private credit capabilities. They've already earmarked $242 million in loans in Q2 to contribute to this joint venture.
Which should be running soon.
Expected in Q3, yeah.
So practically, what does this JV let them do that they couldn't before?
Think of it like this. It gives them more firepower. They can lead larger bilateral deals, participate in bigger loan syndications, basically accelerate their loan growth and the income they make from the interest spread.
Without taking on more risk on their own balance sheet.
That's the idea. They can offer broader deal structures without changing their existing credit profile. Marathon brings expertise. Webster keeps the full banking relationship, cash management, deposits, capital market stuff.
So they keep the client relationship.
Exactly. Fee income from this will be small this year, but should ramp up nicely in 2026. And they stressed this is about enhancing what they already do, using existing relationships and capacity, not a big shift in risk appetite or needing lots of new hires.
Smart way to scale up then.
Seems like it. Leverages their position as a predominantly commercial bank with diverse ways to originate loans. Lets them pick and choose where the risk-reward looks best.
Okay, so strategy sounds interesting. Let's connect it back to the numbers. How does the balance sheet look underpinning all this?
Pretty solid. As of Q2, total assets hit $82 billion. That's up $1.6 billion from Q1.
And deposits.
Also up $66.3 billion in total deposits, up $700 million. Importantly, the loan-to-deposit ratio held flat at 81%. That's a healthy balance.
Good. And shareholder value.
Tangible book value per share grew over 3% from last quarter, now $35.13. So adding value there.
And you mentioned loan growth earlier. Can we break that down a bit more? Total loans were up.
$616 million, or 1.2% linked quarter. But remember that $242 million loan transfer for the Marathon JV.
Right.
If you exclude that, the underlying growth was stronger, like $858 million, or 1.6%. And originations really picked up $3.8 billion in Q2, compared to $2.7 billion in Q1.
Where did that growth come from?
It's pretty broad-based, actually. Commercial non-mortgage loans were up significantly, over $412 million. Residential mortgages also grew, about $210 million. Consumer loans ticked up a bit, too.
Commercial real estate.
That decreased slightly,
Yeah.
but overall, yeah, diversified growth.
And on the deposit side, costs.
Deposit costs edged up 3 basis points. They said that was mainly due to seasonal shifts, like in HSA money and public funds. But non-interest-bearing deposits actually saw some positive movement late in Q2, which is good for future costs.
Okay, turning to the income statement. Interest income up, non-interest income up slightly. Expenses.
Expenses also up a bit, about $2 million. But their efficiency ratio stayed solid at 45.4%.
Meaning they spend about 45 cents to make a dollar of revenue. Pretty efficient.
Yeah, and that drove net income up $31 million from Q1, pushing earnings per share to $1.52 from $1.30.
And the provision for credit losses came down quite a bit.
It did, down to $46.5 million this quarter from $77.5 million last quarter. Tax rate was about 20%.
Let's talk net interest margin, NIM. That was down slightly.
Yeah, down 4 basis points from Q1, landing at 3.44%. There's a little one-off benefit in there, but 2 basis points from a non-accrual reversal.
Yeah.
So underlying M was maybe closer to 3.42%.
What drove the decrease?
Mostly those seasonal deposit mix shifts we mentioned, plus holding a bit more cash and some slight organic spread compression. They say they're still pretty neutral to short-term interest rate moves.
Any guidance on MM going forward?
They expect maybe another basis point hit from holding cash over the next couple of quarters, and another basis point from some long-term debt they plan to issue later this year.
So overall?
Full-year guidance is still around 3.4%. They think the second half might be slightly lower than the first half. They hope to manage deposit costs down if the Fed cuts rates, but admit it'll be competitive if rates stay put.
Makes sense. Okay, let's circle back to credit quality for a deeper look. The allowance for credit losses, the reserve.
Right, the ACL. It was up $9 million from Q1, but mostly just because the balance sheet grew. They took that $47 million provision we mentioned after accounting for $36 million in actual net charge-offs. That brings the total ACL for loan losses to $722 million, or 1.35% of their loans.
And the metrics are improving.
Yes. Non-performing assets down 5%, commercial classified loans down 4%. The ratio of non-performing loans to total loans dropped to 1.00% from 1.06%. Past due loans also decreased.
And importantly,
Importantly, they're saying risk rating migration has stabilized. No new big problems emerging in any specific sector or region. Seems like broad health across the loan book.
We should note where the existing problem loans are concentrated, though.
Good point.
Yeah.
Mostly CRE office, that's about 45% of non-performers in healthcare services, which is about 25% of classifieds. But both are manageable exposures, well under $1 billion each, and they say they're actively working through them.
Okay. What about that rent-regulated multifamily portfolio? Always an area of interest.
Yeah, they have about $1.36 billion there. But interestingly, only 8 deals are over $15 million. The average loan size is small.
And it's seasoned.
Very seasoned, they say. Good debt service coverage ratios, average 1.56x, and decent LTVs. Plus, they stopped originating new loans in this space a while ago.
Smart.
Yeah.
Especially given potential regulatory changes, like in New York.
Right. And they pointed out that over 60% of these loans were underwritten after the 2019 New York law changes, meaning the underwriting didn't assume big rent hikes were possible.
So they're less vulnerable to policy shifts.
That's their view. They don't foresee a material credit impact even if there are further regulatory changes or valuation adjustments. The portfolio's characteristics make it pretty resilient based on past experience.
Okay, good detail there. Let's look forward now. Capital management and the outlook. What are their capital targets?
Short to medium term, they're aiming for an 11% CET1 ratio. Long term, maybe down to 10.5% once markets stabilize.
And that 11% target, what does that allow them to do?
It gives them breathing room, significant resilience against shocks, and plenty of flexibility for growth or shareholder returns.
Like the buybacks, what's the strategy there?
Very disciplined, they say. Priority 1,
Yeah.
grow the balance sheet with good, full relationship loans. Priority 2, smaller tuck-in acquisitions, especially in healthcare, to grow deposits and fees.
And buybacks are?
Priority 3, if the first two aren't the best use of capital, then they return it via dividends or buybacks. So yes, expect more buybacks in the second half if capital allows, but it's part of that ordered thinking.
Got it. And the full year outlook for 2025?
They're projecting net interest income, NII, between $2.47 billion and $2.50 billion. That's on a non-FTE basis.
And that assumes?
Assumes 2 Fed rate cuts starting in September.
Right.
Full-year tax rate expected around 20-21%. It's been 20% so far this year because of some one-offs, but they expect it back to 21% in the second half.
Beyond Webster, are things looking up for regional banks generally?
They think so. Seen some tailwinds. Clients seem more ready to move forward with plans now they've had time to digest things like tariffs. That could boost loan growth.
And regulation.
Regulation seems to be getting tailored more appropriately to bank size and complexity. That could actually strengthen the competitive position for banks like Webster.
And finally, they had some leadership changes.
Yeah, 2 notable ones. Jason Shugel is the new chief risk officer. He comes with 15 years at a Category 4 bank, which is valuable experience as Webster itself grows towards that $100 billion asset mark.
Makes sense. And the board.
Fred Crawford joined the board. He brings a lot of C-suite experience from large financial institutions. So yeah, looks like they're bringing in expertise for the next phase of growth and navigating the regulatory environment.
Definitely sounds like they're positioning themselves carefully.
Absolutely. Both internal strength and external positioning seem to be the focus, especially with that $100 billion threshold looming, which brings more regulatory attention.
Okay, so let's wrap this up. For you, our listener, what's the takeaway? We've gone through Webster's Q2 results, their strategic moves in healthcare and private credit, their risk management, their capital plans. It really seems like their specific business model, those differentiators, are setting them apart.
Yeah, it does. And maybe here's a final thought to consider. Given how dynamic banking is right now, especially for regionals, how might Webster's focus on those really sticky HSA deposits combined with this new private credit JV with Marathon? How might that position them? Not just to grow, but maybe to fundamentally change their competitive edge as regulations and interest rates keep shifting. You know, what kind of bank do you become when your funding source itself is a truly unique strength? Something to think about.
Definitely something to chew on. We hope this deep dive gave you a clear, insightful picture of where Webster is heading. What stood out most to you from our discussion today? We encourage you to keep exploring these trends and how they might shape the financial services sector.